It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
Well, it is Managing Your Financial Future. Welcome once again. Johnny Dean, your podcast host, here with our certified financial planner professional, Professor Rick Plum. Professor Plum,
Yes,
lots of stuff going on in the world. We talked about this in one of our Lucia Capital Group weeklies. We're not going to be doing that today, but sometime I would like to talk about how world events have been happening for
world history
throughout the last several millennia. And the markets, even back in, ancient times, the Greek markets, the agora.
I think you were going to talk about, 1987.
They all recovered, I guess. No, we're not going to talk about that, but we will be doing something like that fairly soon. Also, we had another request for a topic of retiring early. What do you do when you retire early? And just as a quick tease, they've changed some of the rules on things like 72T elections.
And for once, they changed it to our benefit.
In your favor. Can you believe it?
Wow.
It's been a while since that's happened. So anyway, just a brief tease of what we're going to be seeing here, unless we forget, as far as topics go on the on
we are
the
getting
podcast.
Older here.
We are indeed. So never mind the market volatility. And again, it kind of depends on when you're listening to this. Things could have changed, but it doesn't matter. Market volatility is going to be happening.
It always happens.
It always does. It always does.
And
Good
when
to
it
the
goes
high
up
and to the low.
And on the lower side, it tends to happen fairly quickly when it goes down. And it's just another good reason to be bucketized.
Right. Yes. As you may have heard us say in past podcasts, we had a request. We had somebody ask us this. Phyllis, I think, who emailed us at least a few weeks ago. And since we're a little bit behind on some of these topics, we didn't get to it until now. But I would like to talk about this because she mentioned a good topic. And her question was this: could you please do a podcast on asset allocation and withdrawal? For example, what assets should be in tax-deferred accounts versus Roth versus non-retirement account strategies, and the best way to withdraw from these accounts in retirement? So what's she talking about here, Professor Plum?
Well, she's actually, I think, combining two different actual topics. One is asset allocation. Mm-hmm. We know which accounts or which investments we should be drawing from for spending cash. We know which investments we should be leaving alone for the future. Stocks get left alone for the future. Cash and highly liquid, low volatile assets are used to distribute cash flow so I can spend it. So the allocation, is based on how much cash flow I want to generate to live off of, how much I want to spend. That's asset allocation. Yep. That is the purest of bucketology, buckets 101. But the next step is, okay, I know I need to have, $200,000 in safe liquid accounts. Do I put those safe liquid accounts in my IRA? Do I hold them in my personal name, my living trust, my joint name with my spouse? Or do I put them in my Roth IRA? And I know that I want to have, certain assets that potentially will grow. Should I have those growth assets in my, and there's basically, I'm going to look at it as 3 different types of accounts. There's the tax-deferred accounts, 401k, traditional IRA, 457, 403b, your company retirement plan, and your traditional IRAs.
Where you're not taxed now on growth.
Right, you're only taxed when you actually take money out of those accounts, and when the money does come out of those accounts, they're treated as ordinary taxable income.
Yeah, so even if it doubles or triples
in
your
the
investment,
meantime,
you pay no taxes yet.
I can buy and sell to my heart's content, and I will not have to pay any capital gains tax, nor will I be able to use any losses.
Yes, in most cases, that's true. All right, so there's that.
And then there's the Roth IRA, where, again, I don't pay anything on transactional issues. I don't pay any taxes on whatever. It's kind of like Vegas. What happens in the Roth stays in the Roth until it goes on the internet. When it comes out, It's on the internet, and I have to pay tax on it.
In the Roth.
Oh, not on the Roth. It's tax-free as long as it's a qualified distribution.
That's not in the Roth.
So I've got a taxable distribution from a traditional IRA, a tax-free distribution from a Roth IRA, and no tax while we're waiting for those distributions. And then we've got our personal investments. And what happens with the personal investments is whether I spend it or don't spend it, whether I take the money out, don't. And we get this question a lot, especially now about tax time. Why am I paying tax on this? I didn't see any money. I didn't take any money out of my mutual fund. But why is this? What is this capital gain distribution thingy? And well, it was money that you made or the fund made that you have to pay tax on. If it was a capital gain on individual stock, you sold a stock you paid $10,000 for it, you sold it for $12,000, you had a $2,000 gain, and then you bought $12,000 worth of another stock. You still had to pay tax on that gain that you created in that personal account. I created interest. I had dividends paid to me. All of that gets taxed in a personal account when the event happens.
So a personal account is something that's not in a tax deferred like 401k, IRA, whatever.
It's not in
it's not in a Roth. This is money that you generally have available to you.
It's money I had left over in my paycheck that I somehow saved.
Okay, there you go. That's a good way to put it.
And I did not put it into a special account.
So those are the three types.
Those are the three types. So how do we go about picking and choosing what is the most tax efficient distribution strategy? We've created our asset allocation based on how much we need to distribute, although there is a little chicken and the egg because we need to know how much we're going to be paying in taxes. Yeah. And so we may need, depending upon how it's set up, I may need to increase the cash flow to be able to pay for the taxes. But it's kind of a little game that's the fun part again, but that's kind of weird.
That's where your advisor can help you out. But once you retire, you've got Roth IRA. Let's just, in many cases, people have money in each of these. Maybe you have money in Roth accounts.
Yes.
Maybe you have money in tax-deferred like a 401k, very
traditional
common.
Type
traditional
accounts.
IRA, whatever it is. And you've got some personal money. Maybe you've got some stocks.
You probably inherited that because you didn't have any money left over in your paycheck every month, but
could be.
However you came up with it.
But as you retire, you say, okay, well, I need a certain amount of money out of this pool of tax deferred, of personal, so in order to live off of or whatever, I need to take some money out. I'm retired.
Should I take it out of my joint personal account? Should I take it out of my IRA? Should I take it out of my Roth IRA?
Or some combination. I mean,
how dare. But if you go online and you read, and I see this pretty much every day when I look at the financial headlines, the best way to withdraw from your accounts, the worst way to withdraw from your accounts. And invariably, they're trying to take a very complex situation because everybody's different and make it straightforward and say, everybody should do it this way. You should always spend your personal money first. Don't touch your IRA until age 72 or later when they mandate you take it, and never touch your Roth. Leave that to the kids. That's the order that the journalists say it should be in.
Now, journalists very often are not the same people who are meeting with clients on the other side of the desk who are actually managing their money.
And the problem is that's very easy to understand, but usually easy to understand doesn't necessarily make it the best way to do things. And everybody is different. That may be the perfect advice for somebody who has a fairly large a personal account, moderate IRA or moderate Roth, but it doesn't work for most people. And so how you should be taking money from your different accounts, which assets should go into each different account, depends on the size of your accounts, how much your income is. Do you already have a lot of pension? Do you have a decent amount of Social Security? Are you deferring your Social Security until 70? What's happening in your life? And you have to understand the tax brackets. Oh, heaven forbid we understand the tax brackets. Because there's a lot of times, especially if you're retiring in your 60s and you're going to defer taking Social Security until age 70. In many cases, it's better to start taking distributions from your IRA at that point and use that and get that money out in a low tax bracket. Now, unfortunately, we have years like last year, or fortunately, we have years like last year, where we're doing our taxes now and people are saying, what the heck is this? I had an $80,000 capital gain in my account last year. It happens.
How does that happen?
Because they had a mutual fund or they had a managed account that was being, and the things were sold at very good gains. Like last year was some pretty good gains.
You mean the mutual fund company sold them?
And the mutual fund, and we see this quite a bit.
But the owner didn't make a sale, in other words.
The owner may or may not have made a sale, depending upon whether they had a mutual fund or whether they had ETFs and individual securities. So unfortunately, there's some things that are outside your control, but generally we're looking at how should we be allocating these monies, and it has a lot to do with where you are and what you're trying to accomplish. Now, as a general rule of thumb, that's going to be probably changed for everybody out there, you would normally look to put your assets that create ordinary income. Especially if you're going to try to live on interest only, which is almost impossible today. Yeah. But if we ever went back to where you could actually earn some interest, put the interest creating accounts in your IRA and take the distribution of interest to spend.
Like what? Example of what?
Back in the day when CDs would pay 4 and 5%, 6%, if I own a CD that's paying 4%, this is historical terms, I have $100,000 that's paying $5,000 in interest, and I'm going to spend $5,000. Well, I might as well have that coming out of my IRA because it's going to be taxed identically. If I have $5,000 in my personal, interest, that's going to be taxed as ordinary income. If I have $5,000 that came out of my IRA, that's taxed as ordinary income. They're taxed identical in that situation if all I'm doing is spending the interest. So it depends on how you're doing things. But generally, we're looking to put assets that create ordinary type of income, ordinary dividends, interest, things of that nature, in the IRA because it's going to have the same tax treatment coming out of the IRA as it did personally. Now, capital gains are a different game. It also depends on whether or not we have any control over the capital gains and whether we can get them to the long-term side of the house instead of short-term capital gains. But as a default...
Let's speak on long-term because I think for many people it's...
As a default, I'd almost rather have my long-term capital gains in... Now, this is after I've retired. In my personal account, especially as individual securities or ETFs where I can control when to buy and sell. Or when to sell specifically.
So not in an IRA, not
have it in my personal account because if I put
not in a Roth,
I put and I'm looking at growth stock. Well, Roths are the wild card in this. We'll get to that one in a minute.
Okay.
If I have I put $100,000 into a stock that does not pay a dividend, I'm looking for it to grow, in one of the Nasdaqs or something. If it grows to $150,000, do I pay any tax? Not unless I sell it. So if I'm going to buy and hold a stock for a very long time because I really like the stock and I'm going to forget about it and leave it to the kids or whatever, whether I have that in my personal account or my IRA, I'm not paying any taxes on it because I didn't sell it. So having that tax deferral in the IRA hasn't really helped me too much. And when I die, I give it to my kids.
They're going to pay taxes.
No. If it's in a personal account, they get a step up in basis.
Well, yes, I'm saying it.
Now,
but
if it's in my IRA, they get to pay taxes. So how we're using these funds has a big impact on which account they go in. She asked what would seem like a very straightforward, answerable question.
Our emailer Phyllis here.
Yeah, but it's very difficult to answer because you take into consideration all these different aspects. And where are we on the tax brackets? Can we get long-term capital gain? Is that capital gain going to subject more of our Social Security to taxation? Would it push us over the IRMA limits? How are we going to control the taxation? Now, the reality is people have the majority of their money, at least most people we've seen, I've done no studies across the U.S., have most of their money in IRAs.
IRAs or what? 401ks,
yeah,
maybe?
Tax-deferred accounts.
So let's say, yes, I don't know about IRAs, but certainly many people who have retired, who have been working a long time, who had a 401k.
Now it's an IRA.
Now it's an IRA, perhaps, or it's a 401k, but
they may have, 25% of their money in a personal account.
But don't they have isn't that a lot of capital gain assets in those 401ks and IRAs in many cases?
It doesn't matter what is in the IRA. It doesn't matter what is in the 401k. Mm-hmm. When the money comes out, it's ordinary income.
Right. And you had said earlier that you prefer to see those capital gains types in a personal account.
In a general rule. Knowing that the general rule is very vague.
Right, but the reality, as you're saying, though, is that people a good portion of their money is in tax deferred, like
Right.
a 401k.
So how do we create a tax efficient use? And that all comes down to what's happening in their life as far as, do they have a pension? Are they taking their Social Security? When are they going to take their Social Security? And how much room do we have in tax brackets to either do conversions or spend some of the bracket to be able to, take money out? We have the ability to take some money out in a very low bracket depending upon what other incomes we have. So taking money out of an IRA may be a good thing. Taking money out of an IRA may not be a good thing. It all depends on what's happening in your life. But like I said, as a general rule, ordinary income assets inside the tax deferred account, capital gain assets personally, but that's going to change almost every time.
You mean with every individual situation?
Every individual situation. Now we throw in the wild card, the Roth. Now, while we're working, that tax deduction of putting money into a traditional IRA is our friend. When we're retired, that tax deduction that now creates taxable income. If I were retired right now and I had $1 million, I would love to have 100% of it in a Roth IRA when I retire. But getting it there was just too costly while I was working.
Of course.
So unless you've been very diligent through the years, most likely the Roth component in your account is a fairly small as a percentage of the overall.
Mm-hmm.
So what do you do with that? I mean, you've got $50,000 in a Roth. You've got $1 million total investment net worth.
Just for easy math.
Right. And 5% of it. So I put the $50,000 into something that's cash bearing, something that's going to create income, or I'm just going to take distributions of principal because it's been 5 years and, it doesn't matter. Everything I take out of the Roth, I'm going to do that over my lifetime. It's going to give me, a couple $1,000s a year. Does it really help me that much? And maybe it does, but maybe it's enough to keep me out of IRMA. Maybe it's
that's the extra expense you're going to pay
for Medicare when your income goes too high.
Yeah.
But with 5% in a Roth, generally, that's money that you should let grow for A, either your surviving spouse, or B, your heirs. So that would be growth-oriented assets, and those are capital gains, which really are the least the least tax efficient to put in a Roth because you get a tax break on them anyway, but you want to grow that Roth as much as possible so that the kids get as much as possible.
On a tax-free basis.
And you don't have to worry about a required minimum distribution at any time.
That's true.
So,
as the owner, you
right.
don't have to. What ideally, what do you like to see, though? I mean, somebody who retires, they've got a good portion of their money in IRAs, let's say, or tax-deferred, 401ks, IRAs. Would you like to, if you can, do you look to try to get the money out of those tax-deferred, if possible?
We always look to whether or not we can afford, tax-wise, to obviously satisfy the income needs, but then if there's room in the tax bracket, can we then do conversions? We don't want to leave a good tax bracket alone. If we got a good tax bracket, we want to use it.
Well, which you may have if you're retired, if you hit age 65, right? Or whenever you
60,
retire.
Whenever you retire, there's always potential. Now, it depends on what other incomes you have. If you've got tons of rental income, tons of pensions and things of that nature, you just may have to resign yourself to the fact that going to pay some tax.
But what you like to see on an ideal situation is somebody who's maybe they just retired. They got a good portion of their money in a 401k or IRA. And tell me if I'm wrong. Their tax bracket is lower because they're retired. Their earned income has gone down. So getting that money from the tax-deferred side into the
tax-free
post-tax side, however you want to do it, or tax-free side. You like to see that? Do you like to see somebody reduce their tax-deferred accounts going against what the journalists always say?
Well, and that's where the journalists can potentially get it right is if you're going to use, hey, live off your personal money. If I've got, $500,000 in personal money and $500,000, $1 million, again, easy math, in my IRA, hey, living on my personal money isn't the worst thing in the world. I can set up that $500,000. Some of it's going to be in a very low interest bearing. So I'm not going to be earning tremendous amounts of cash flow on those safe assets, which is going to be probably $200,000 or $300,000 of it. And the other $300,000, we could try to be a little tax efficient. not going to be a big tax problem there, and it's going to create cash flow. I can get my $40,000, $50,000 of cash flow a year, not from the investment return, but from some principal coming out of that, and be in a very low, if not zero, tax bracket for a little while. But if I'm in that very low or zero tax bracket, don't let it go to waste. Use the IRA. Do conversions. Move that money from the traditional IRA. Don't let the IRA just grow until the IRS mandates you. Maybe you're 62 when you do this, and you're going to let your $500,000 grow for another 10 years until you have to start taking RMDs. Now you've just jumped way up. You need $50,000, $60,000 a year to live. Now you've just pushed your IRA up into the $1 million plus range. Your RMD is going to be $40,000, $50,000, and now you're also taking your Social Security. You went from paying no taxes to paying a bunch of taxes for the rest of your life, and it only gets worse if you're married and you die and you leave a surviving spouse, and now they've got a same big required minimum distribution, but half the bracket that you had before.
And maybe your Social Security is
some of the Social Security goes away, but almost all of it's taxable, if not all of it, or 85% of it. So how you set yourself up is very dependent on what's going on in your life.
So the lesson to take away from all this would be that you should know your tax bracket currently, correct? Know how much it's going to cost you in taxes to take money out of that,
and don't
tax-deferred account.
When you look at your tax return and it tells you your effective rate, don't use that for planning purposes. Your effective rate is the average. And depending upon which program you're using, it's either the average tax you paid on the taxable income, or it may be the average tax you paid on your adjusted gross income. That's probably not your entire income. So, but it's still the average.
But you have to know what the next dollar is going to cost.
You want to know what your marginal bracket is. So if I've got an average bracket of 8% and I take $10,000 out of my IRA, that doesn't mean I'm going to pay 8% on my IRA money. I may be paying 20%, even if I'm in the 12% marginal tax bracket. Well, how does that work, Rick? Because even the marginal bracket, unless you know that you're already maxed out your Social Security taxability, the marginal bracket doesn't even tell you the whole story of what you're going to pay unless you know what's going on with taxes. And I'll just throw it out there. How many people really know what bracket they're in and know what's going on with their taxes? We all complain about it.
I found out last night because I did my taxes last night. But otherwise, no, don't pay attention to it.
It's going to sound weird.
No, it's not. I know what you're going to say.
I did my 2021 tax return in February of 2021. I did as close of a projection as I could, and I set my withholding so that I would get back a little bit of a refund, and I did. I'm doing my 2022 tax return right now, based on everything we know that's going, what the 2022 return will look like, so that I withhold enough through the year. And it's weird. When I did my tax return, I'm getting a refund, but my tax return has printed out estimated payments. I'm like, why am I getting estimated payment? Because I'm required, to stay in the safe harbor rules, I'm supposed to pay 110% of last year's. Well, I wasn't, I didn't withhold 10% more than I was supposed to. So they want me to withhold another X amount of dollars so that I stay within the safe harbor. I'm not going there.
No, we've talked about that before.
But it was weird. It took me a minute. But my effective rate was a lot lower than my marginal rate.
Well, as I found out too, it helps if you're, like, my wife retired halfway through the year last year. I did my taxes. I said, I'm getting a refund.
For once.
I don't believe it. It's been years. Yeah. But again, this is where you need to know what your tax bracket are. If we're going to be in a lower tax bracket, my wife worked half the year last year, retired. I did not take any money from any of her retirement accounts, which we can do because she's over 55 and all that. I did not take any money out of those accounts. I waited till this year where I have an entire year where I'm going to be in an even lower tax bracket in 2022. So what you're saying is I need to know that I'm in that lower tax bracket. So if I want to take money out of my tax-deferred accounts or 403B, whatever, this is a good time to do it. Don't waste that low tax bracket.
And as you get close to the end of the year and you realize you did not take as much out to live as you might, and you've got room left maybe you have $40,000 worth of room to be able to take it out in the current tax bracket, which is lower than what you've been in, and will be lower than what you'll be in the future probably. Well, don't let that, and you take 15 out to live.
Yeah.
They got 25 left in the tax bracket. Do a conversion.
Now you're gonna pay taxes on that money,
Right, but you're going to pay less taxes today because we know where we are in the bracket. Then we're expecting to pay later on when all the Social Security kicks in, when the pensions kick in, when you've got the 10 million in your IRA or the Mitt Romney IRA with 100 million in it coming out as a required minimum distribution.
Well, some people recoil at the idea of I don't want to pay it now. I mean, I can push this off. You mean I can push this off until I'm 72 or something?
Right. But if you could pay 12% today versus 25% a couple years from now, which one's better? It's the old, what was it, AMCO? Pay me now or pay me later?
No, wasn't it Pennzoil? We figured that out one time. I thought it was Fram.
Fram air filters.
I think it was Fram air filters. Well, that's
pay me
just
now
it.
Or pay me more later.
Well, exactly. Now, and here's the other thing. If you take money out of your tax-deferred accounts like your IRAs or your 401ks or whatever, and you're gonna pay taxes on it, I mean, can't you just take extra and say send that off to the IRS so that I don't have a bigger tax bill when I do my taxes in April?
You can do withholding from an IRA. Yes, you can definitely do that.
As much as you want?
I was working with somebody who was 72 plus years old. Actually, they were 7.5 at the time. It's a couple years ago.
Yeah.
They were still working, and they were not withholding enough from their paycheck to be able to cover their entire tax bill. And they had to take a required minimum distribution from their IRAs. So what they did was they took X amount of dollars from their IRA as their required minimum distribution, withheld 75% of it for a federal tax withholding and 25% of it for the state tax withholding for the state they lived in. So
they didn't get any.
They didn't get a dime of the required minimum distribution, but it helped pay their taxes, and that was fine with them.
Which maybe
you got to pay the taxes anyway,
right?
You got to take the required minimum distribution anyway.
I find it easier to pay taxes if they just give me a certain amount left over and withhold and send the rest off.
I'm not a big, me personally, maybe it's because I'm lazy and I don't like having to think about doing it. I don't want to do estimated tax payments. I'd rather have it done withholding wise.
We haven't, you mentioned estimated tax payments again. This has to do with what you mentioned a little bit ago.
To avoid penalties.
Yes. There are safe harbor. You have to have withheld. Do you want to just mention it really quickly? I don't want to confuse people. This has been a very detailed topic we've talked about.
And we're just scratching the surface on this topic. And because when you're talking about growth assets, you've got mutual funds of stocks, you've got ETFs of stocks, you got individual securities. Some of them are easier to manage from a tax standpoint than others. And so which ones do you put into your growth account or into your IRA, your Roth, your personal account? I change the structure depending upon the size of the account of my growth accounts, how I'm going to invest them, depending on whether it's a personal account or whether it may be an IRA, because in the IRA I don't have to worry about capital gain distributions. But anyway,
you mentioned
estimated taxes.
You mentioned the safe harbor. Let's talk about it very quickly.
To avoid paying an under withholding penalty, you are required to pay in the lower of two different numbers, and one of the numbers actually changes depending upon how much income you make. You have to pay in either 90% of this year's actual tax liability. So if I owe $10,000, as long as I've paid in at least $9,000.
If your tax bill was $10,000,
my actual tax bill on my tax return, not my refund.
No.
If my actual tax liability was $10,000, as long as I have paid in $9,000 plus in withholding or quarterly payments, I do not owe a penalty. Even though I may be short, maybe I paid in just $9,000 and I owe them another $1,000 when I pay my tax return. Don't owe them a penalty because I'm within the rules. Now, on the other side, as long as I've paid in at least 100% of last year's tax liability, maybe last year, I had a fairly low tax year and I owed $3,000 in taxes. This year, I won the lottery and I owe $300,000 in taxes. As long as I've paid them $3,000, I can pay the remainder that I owe them this year when I file my return and not owe a penalty.
What's the under withholding penalty?
Right now, it's not very much, but
yeah.
it's an interest rate. It's probably less than 3%. I don't even know, but I don't like giving them the money that I actually owe them, let alone giving them more.
Yeah, it's not that much, and I've been a victim of that for a few years, having owed taxes in the past.
Now, if your income was over $150,000 last tax year, you have to. The safe harbor is 90% of this year's or 110% of last year's. But like I said, as long as I know where I'm at, and I don't like giving them the money that I actually know I owe them. I do not want to pay any penalties, even if it's $50.
There's just something about it.
Yeah,
there's just something about it. This has been I called it a detailed topic. You said we just scratched the surface of this, but this is what a financial advisor should be looking at, in your opinion. To
understand the taxability of the portfolio, especially a personal portfolio. If all you have is IRA and Roth IRA, it's fairly straightforward. Just the distributions are taxable as ordinary income. The problem is in the personal accounts. And how is that personal account invested? Is it mutual funds? Is it ETFs, exchange traded funds? Is it individual securities? Who's managing those individual securities? How often is it? What is the turnover? How often do you buy and sell within those accounts? Now, what's going on in your personal account? Because, like I was mentioning earlier in the podcast, a lot of people are getting a little surprised. They enjoyed seeing the values on their statements going up last year, but now the roosters come home, or whatever they call it. The crows have come home to roost.
Chickens have come home to roost. Yes.
Now the piper's got to be paid, for some of those sales that happened last year.
You talking about for
capital gains from a tax standpoint. Yeah. And a lot of mutual fund, people that owned mutual funds the whole year, they didn't sell, but they got a large capital gain distribution last year
because the mutual fund company,
the fund itself, bought and sold within the mutual fund.
Yeah.
And unfortunately, we see that a lot. We see bigger capital gains in down years. This may be, depending upon what happens towards the end of this year, this could be a big capital gain distribution year for people who lost money in their accounts.
You're saying this year, meaning
2022.
22.
Right.
So next year when they pay their taxes.
Right. And because when people get afraid, they sell their investments and move to cash. Well, when I sell my mutual fund shares, who am I selling them to? It's not on the open market. I'm selling them to the mutual fund company. I'm redeeming my shares with the mutual fund company. Where does the mutual fund company come up with that cash to buy my shares? Well, if it's a very small number of people redeeming, they probably have a little bit of cash that they can do it with. But if 15, 20, 30% of their shareholders bail out, they have to sell assets, the mutual fund does, to create the cash to be able to redeem the people that are leaving.
Which is
when they sell those assets, they may have owned the stocks for 15, 20 years in there, triggering a capital gain inside the mutual fund that gets distributed to the shareholders of record at the end of the year.
That's something that really does catch people off guard. If they've never owned mutual funds
the bigger the market drop, the bigger the sell-off. The bigger the sell-off, the more the mutual funds have to sell.
Which creates a bigger capital gains tax bill for the people whose portfolios, coincidentally,
so if I'm buying in,
are down.
I mean, for a long time, it was never buy into a mutual fund in the last half of the year in your personal account.
Yeah.
Because you may be getting a tax bill that you didn't experience any gain.
You bought a fund in October and I
paid $10,000 for it. It's now worth $9,500,
and I got
a tax bill.
The only good news of that is, Professor,
that adds to your basis.
So it's you're paying taxes now, and then
what good does that do me when I get my tax bill and I jump off the building?
Don't do that. Don't do that. It's just money. These are things that are these are complicated topics. What Phyllis was asking us was, how do you determine, I think, or at least this is what it turned into.
Allocate
how do you
or tax manage the portfolio?
When you withdraw, you've got personal money, you've got Roth money, maybe you've got tax-deferred money. I need to take some of this out of my portfolio. I got 3 doors to choose from, Monty Hall. Which one? Or 2, or whatever.
Always choose the one Carol Merrill's in front of.
Which one? Man, are we dating? We do this every single podcast. Ask anybody who's under 40 who Carol Merrill is. You have to figure out where to take the money from. And what you're saying is, what your answer has been for this podcast is...
It depends.
It depends, and it depends on a bunch of factors. If you're going to try to do this yourself, there's a good chance you're going to mess yourself up in some way from a tax standpoint. If you're not messing yourself up now, you could be really messing yourself up
for the future. I mean,
in the future for the rest of your life.
We see this a lot where people reduce their taxes today to almost nothing. Yeah. But without considering what they're doing for the future. And most of the time they're deferring. And all of a sudden, boom, they get a lot more taxes at 72 and later, and there's nothing they can do with it at that point.
And you love looking at this stuff. This is stuff that
It's interesting to me. I mean, I remember teaching a class on this to advisors and to the bigwigs in the company I was teaching it to, and we went through a tax return, and we played detective. And we just said, here's how you can tell what's going on with these. Mm-hmm. And the president of the company was like, you can find that much information from a tax return? I go, sure. I mean, we get a lot of information from tax returns, how they work and what people are doing. Yeah, it makes sense.
And the best way to figure out what you're going to owe is to know something about it. If you don't know something about it, you could talk to a financial advisor, Professor Plum, or any of the Lucia Capital Group advisors. They do this stuff. Yeah, the whole team of advisors at Lucia Capital Group, Professor Plum, that when they look at this stuff, you look at this stuff.
We talk about this stuff quite often.
Yes, they get together with you oftentimes. They'll say, well, what do you think about this? It's sort of a group, maybe a
groupthink? No.
I almost said that. That's not the right word. But you have a few different eyes on this.
Oh, yes.
And you're able to maybe, hey, you know what? Maybe they should do this differently. But everybody's situation is different. And this is the key that you need to take away. Don't read in a journal somewhere that you should always do this, as Professor Plum said.
Well, we said in the past, if you see the words always or never, be skeptical. Because I don't know that I've ever found anything in financial planning that is always this way.
Always pay the taxes you owe is probably a good thing. But other than that... Other than that, I can't
try
think
to
of
never
anything
pay
else.
A penalty.
That's a try, though. Yes, it's never good paying penalties, I don't think.
Never put yourself in a position to have to pay penalties.
All right, there you go. But there are very few. Talk to Professor Plum or any of the Lucia Capital Group advisors, 800-644-1150. You want to know what tax bracket you're in? You want to have somebody take a look, perhaps, at a tax return that you have and say, you're retired or you're almost retired. I think you need to be doing this. And as Professor Plum just showed, today's podcast, it can be complicated. All of the things that they have to take a look at and all the things you said, play detective on a tax return, this is exactly what you do. It's a good idea to have somebody take a look at it. Again, 800-644-1150. That's the number at Lucia Capital Group. All plans go through you, Professor Plum?
Right. And now I will say, just because we're taking a look at it doesn't mean we can do anything about it. I had somebody every year, they bring their tax return in and they say, what can I do? It's like,
to reduce taxes.
To reduce taxes. Like, well, you've got you work for somebody and you make X number of dollars and that's the only income you have and you don't itemize. So the only thing you can do is make less money.
You quit
or move to a different state.
Are they in our particular state?
Yes.
Yeah, there you go. There you go. You want to get in touch with them, do that. Call that number, 800-644-1150, or go to luciacap.com, LUCIACAP.com. Lots of resources there. All of our, many of our videos from the past, you can find those there. You can find other podcasts there, all kinds of articles, information. And hey, you know what? As Professor said, it doesn't hurt to have somebody take a look at it, and hey, maybe you can do something about it. Maybe able to manage your tax bill.
Maybe not always, but there are times.
Even managing may just mean you're doing it just right,
and knowing that you've done everything you can. There's some satisfaction in that too.
Absolutely. I thank you, Professor Plum, so much.
You're welcome.
For being here. If you want to listen to you should be listening to our podcast on Spotify. That's where you find us. You can also subscribe and download, listen to your heart's content. We have a couple more left in this season 8. Wow. And we'll come back next week with yet another exciting topic. I'm hoping it's not quite as detailed as this, but we'll find out. How's that?
We'll see.
That's right. Thanks so much for listening. I'm Johnny Dean for Professor Rick Plum, Certified Financial Planner Professional. Thanks so much. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an ETF's, a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated.
NASDAQ Composite Index is an unmanaged index and measures all NASDAQ domestic and international-based common stocks listed on the NASDAQ. An investment may not be made directly in an index. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.